Good morning and welcome to the Killik podcast for Friday the 27th of March. This week we've seen volatility in the oil price with Saudi military action. We've also seen a very big merger between Kraft and Heinz. But the key mover for markets again has been US interest rates. So US interest rate policy continues to be an important driver for markets, with the Federal Reserve talking up the US economy. At the same time though, they're pushing back expectations for interest rates going up. So as a result, you've got this sort of moonwalking scenario which the financial commentators are referring to. We're going to have a quick look at the way high growth stocks and bond proxies are reacting to interest rates in order to get a sense of how we should be looking at this in the equity markets. So over the last week, we've had 4 of the 12 regional bank governors in the States talk up the US economy and the prospect for rate rises. This has created quite a big move in some of the higher yielding stocks. So when we look at the NASDAQ, biotech, this is a good example of stocks that are very sensitive to interest rates because their revenues are a long way in the future, and the discounting mechanism means that their valuations are very sensitive to interest rates. So here we can see, having had a fantastic run throughout the last 2 years, we've seen another quite sharp pullback back to the 50-day moving average in the biotechs. And that's actually the biggest one-day fall in biotech pretty much this year. Same time, we've seen bond yields continue to slip after the FOMC meeting last week. And we saw poor data this week with the durable goods number in the States. So bond yields have been going down. US dollar has paused for breath. That strength has sort of started to normalize. And here you can see the euro has actually strengthened against the US dollar over the last couple of days. So we're trying to make sense of what to listen to and what parts of the market we really should be in. So what we do look at quite a lot is how bond proxies are reacting to government yields. So here we're going to have a look at the US, European and the US bond proxies. So we've used the utility sector an example for bond proxies. So that means low growth, high yield. So the valuation of these stocks tends to, or the relative attraction tends to be benchmarked against bond yields. So here we can see in the UK as the UK bond market, bond prices go up and bond yields go down, the relative attractiveness of utility stocks goes up. So you've got a positively correlated chart there. And as you can see here, those two charts are following each other very closely. And that suggests that the market is very relaxed about interest rates going up in the UK. Perhaps we've been too bullish about rates going up in the UK economy over the last year or so, and we're probably moving towards a realization that rates aren't going up anytime soon in the UK. In Europe, it is sort of the opposite. So you're starting to see the bond utilities, bond proxies outperforming yields. So bond yields, for example, have been very strong in terms of the price. So yield in bonds have gone down significantly, and that's making the utilities in Europe look that much more attractive on a relative basis. So you can see that outperformance, and almost no concerns about rates going up anytime soon. So you probably will continue to see outperformance in European bond proxies. But probably the most interesting chart is in the US. So here we've seen a decoupling of that bond proxy relationship to the 10-year gilt. And even though yields have been bonds have been going up and yields have been going down, we've seen a sell-off recently in the utility space in the US. And that suggests the market is now looking through this recent pullback in bond yields and expecting rates to go up later in the year. So they're listening to what the Fed governors are saying about the strength of the US economy. That is obviously not in conjunction with the way the FX markets are looking at it and the way the bond markets are looking at it. So that's a very interesting divergence. For us, that puts the onus on the first quarter results. So if the market is expecting the economic results to pick up this year, then we need to start seeing that growth coming through in the ones which will start in April, so we'll be watching that very closely. Here you've got a chart of US cyclicals, and you can see year to date they've been, they're really back to where they were at the start of the year, so they've given up that outperformance in the early part of the year. We feel that it's now a good time to start looking at those stocks again, because we feel that the growth will come through in the second half of the year, and within the UK, within the Killik recommendations, we'd be looking at Union Pacific and Michael Kors as our favoured picks. In terms of the week ahead, we're going into Easter week, so the timetable is very thin. The key stock for us is Marks and Spencer's. Marks and Spencer's had great interims last November, but they lost a bit of their momentum in their January trading statement, the Q3 trading statement. So we'll be looking for margin guidance to be maintained and looking for continued progress in that area to sustain the recovery in the share price, which has been strong into these results. So that's it from me. Have a good weekend. Thanks very much.